All right, guys, we're going to jump into it. So the Federal Reserve has kept interest rates where they're at. I'm going to show the screen right here. There's some news articles on it, but they are signaling rate cuts later this year, possibly in September. So Fed's holding interest rates, but keep your doors open for a cut in the coming months. Right here, I expect that further good news on the inflation front in July should set up a chair to deliver a more meaningful signal that a rate cut in September is very likely. So we'll see what inflation does, but we might possibly have a rate cut. Now in this video, I'm going to break down what's a rate cut, how's it going to help you. We're going to break down the impact on a mortgage as well. So I'm going to show you that in just a second. The Federal Reserve says if all goes really well, we could even end the year with the average rate on a 30-year mortgage closer to 6% than 6.5 or 7%. I think 6% is very optimistic, so I would expect more in that 6.5%. Now, all of this comes because there's going to be a rate cut in 2024, and then they're signaling steeper rate cuts in 2025. This article saying, hey, we're going to see just one rate cut in 2024, but there could possibly be 4 cuts in 2025. That could have a giant impact on mortgages. It makes them a heck of a lot more affordable, obviously, when you have lower interest rates. Now, typically when interest rates go higher, then house prices go down. When interest rates go lower, then house prices go up. They have an adverse effect on each other. I don't know if we've quite seen the drop in house prices from this increase in interest rates that we've had since 2020, when it was like 3% and super cheap to get a mortgage. We have seen some drop, but not as much as I thought we would. Now we'll see if these rate drops that they're planning will actually increase the price of houses. Yet to be seen. So I'm going to bust out on Excel the things, a mortgage, showing you exactly what principal and interest would be. I'm going to use this average home price in the United States, which is $412,000. And I'm going to do some analysis as well on, how much of a percentage of your gross income would housing be. Now I'm going to use the medium household income, which is $74,000. So let's jump over to Excel real quick. This is super easy. If somebody wants to do this, I can actually show you. It's really easy. It's an Excel. You can just open up Excel and click loan amortization schedule, and then you can put in all the inputs. I'll show you what I did. Current loan. So right here, if you see up here, there's $412,000, and I'm going to say you put 20% down. So your loan would be 80% of $412,000, which is $329,600. Now, interest rate, annual interest rate, I'm saying 7% right now. That's about the average right now, is 7% on a mortgage. Loan period in years, I'm going to put 30 years. So we're just going to go a traditional 30-year mortgage. Obviously, there's 12 payments in a year. So that broken down gets you to $2,192.84. Now, that is just principal and interest. Typically, when you have a mortgage, they're also going to roll in, your property tax and homeowner's insurance, and that's usually paid through an escrow account. So you usually have that on your mortgage as well. So don't think that you're going to get a $412,000 house just for $2,200 a month. Obviously, you're going to have some other expenses associated with it. But this is principal and interest. So right now with over here, if you can see monthly gross income, I'm going to blow this up a little bit so it's easier to see. I did 74,580 divided by 12. That's your gross income for a month, which would be $6,215. Now over here, I just said, hey, I want to see what the total payment divided by my monthly income, how much of a percentage of my monthly income is that? And it is quite high. It's 35%. And that does not include property tax or insurance. That's way high. Typically, I would tell people to not go above 28% of their gross income should go to housing. If you do that, you're just going to be house poor. Nobody wants to be house poor. You want to be able to live life, enjoy some things, obviously go on vacations with your family. Now, if you're spending 40% of your income or even 35% of your income to housing, it makes it more difficult to do the things that you want to do. Okay, now let's break down just how much of an impact a rate cut would have. So if we go to, I have this other tab, this would be if there was a rate cut and it dropped to 6.5% instead of being at 7%. Typically what I've seen though is rate cuts are 250 basis points. That means it is 0.25% by the Fed. Now it's not directly connected to mortgages, but it does have an impact on it. So if we say, hey, let's just be generous. If rates by the end of this year were at 6.5%, at 30 years, 12 payments a year, I'm doing the exact same house price, and let's just compare. So obviously your scheduled payment's going to go down. So I actually have it over here. The old payment was right around $2,200. The new payment just linked right here, $2,083.30. So that would be a monthly savings of $109. So that's $1,200 a year, which is, I mean, it's money. $100 is $100. I wouldn't walk down the street, and if I saw one laying on the ground, I would pick it up. So I mean, obviously, $100 saved every single month is a good thing. Now, I also went and did a comparison between the total interest paid if you kept the loan for the life of the loan. So the old loan, cut over here, it's $459,000 on a $329,000 loan. That is how much interest you are going to pay. So over the life of this thing, on a $329,000 loan, you're actually going to pay $789,000 to purchase that home. It's because 30 years worth of interest is a beast, right? So now let's go over to the rate cut. So old total interest, $459,000. New total interest is $420,000. So that saves you $40,000 over the life of this loan just by having 0.5% difference on your interest rate. Now, one thing that I always like to do, I always like to check this out. There's this, in Excel, you can do this optional extra payments. I love to see how this impacts how much interest I make, or how much interest I'm being charged, and how quickly I can pay down the loan. So let's just say, your budget for a house on principal interest was that $2,200, but you financed it at 6.5%. So you're saving yourself, $109 a month. So let's just take that $109 a month and let's throw it on this optional payment, just to see how big of an impact it has. Now look at that. It drops the total interest paid. It was at $420,000. It drops it to $353,000. And that is a giant difference. So you're going to save a lot more on your mortgage just by making that extra $109 payment. Now look, it also actual payments drops that to $312. So I'm going to go over here to the side and just say, okay, hey, if I did $312 divided by 12 payments a year, I am paying off my mortgage in 26 years instead of 30. So 4 additional years of not having to pay a mortgage. That's pretty significant. Now, I'm showing you all of this so that you can go and do it yourself. It doesn't have to be just with interest, right? If you can save yourself $100 a month, whether that's eating out or getting rid of your credit card debt and then taking all of your payments that you're making on any credit card debt, or the drop in your eating out budget, or any little savings that you have, you can throw it into here and see how big of an impact it has. It can be significant, right? So if I put this back to zero, 420,000, and just adding $200 a month, it drops it at $100,000. That's a huge savings that can be big over the life of this loan, right? Okay, so that is breaking it down from the rate cut that's supposed to happen in 2024. Now, if we get 4 rate cuts in 2025, it could drop the interest rates by a full percent, and that could be pretty significant. So I actually went over and I did it. What if I waited until all of these rate cuts happen in 2025? Or what if I refinance in 2025? And I'm doing the exact same house. I am doing 5.75%. We could do 5.5, but I'm going to say 5.75%. That is 1.25% lower than what it is now. 30-year mortgage, 12 payments a year. The old payment, right? This is one if you just financed right now before any rate cuts, it's that $2,200. Now, if you refinance with 5.75, your mortgage payment would be $1,923. That is $270 in savings every single month that your mortgage is going to drop. Now, I did the exact same thing. I checked, hey, look at the old interest compared to the new interest total paid, and it drops it by $97,000, which is a significant amount of money. Now, watch this though. This is going to be the crazy thing. So if I'm going to put this over here because I want to see it. We're just going to copy this and paste to values. Now, we're getting charged $362,844 in interest over the life of this loan. Now, if I took that difference, if I refinanced in a year and a half or whatever, and I dropped my interest rate by 1.25%, but I just kept paying the exact same amount on my mortgage, I just kept paying this additional $270. I'm going to put this in this optional payments. Now check this out. It drops from $362 to $254, which is $108,000 difference. And that's just comparing making the additional payment to this current loan. If you compare it to the old loan, I'm saving $205,000. That is a crap ton of money. Obviously, if you can have an extra $205,000 to your name, yeah, go for it, right? It's going to be huge. That's how big of an impact just making, those payments. Now, that does not account for any ways that you can be frugal, because I'm a firm believer that there are two ways to make money in this life, and one is to increase your income, and two is to decrease your expenses. So if you decrease your expenses and then just take that money that you've saved by decreasing your expenses and throw it onto your mortgage, you're going to have significant advantages. You're going to save a ton of money in interest payments over the life of this loan. So that's how big of an impact interest rates can have. Small ones, that it's not going to be a huge change if you just drop the interest rate by 0.25%. Typically at that point, I don't even refinance. So I've refinanced multiple homes, and when I do it, I typically kind of calculate out payback period, because every time you refinance a loan, there's closing costs, there's things that have to be paid. You might end up paying a couple grand in closing costs. So if I have $3,000 worth of closing costs, but refinancing is only going to save me $25 a month, then my payback period is kind of a long time, right? If it saved me $25 a month every single year, that's only $300 a year. And if I have $3,000 worth of closing costs, I'm not going to make my money back on that refinance for 10 years. So at that point, I don't refinance. I wait for a bigger rate drop. Now, if you dropped, from 7% down to 5.75%, at that point, absolutely, it's super worth refinancing, because if I have a $3,000 closing cost to refinance that mortgage, but I'm saving $270 a month, it's only going to take a year to make all of my money back from closing for that $3,000. And then at that point, I'm just, money to the bank. So I look at it that way. I don't suggest refinancing every 0.25% drop. I think it's silly, because you're not going to get your money back for a long time. But when you start getting into like 0.75% or a full percent, at that point, yeah, it's most likely going to be worth it to refinance and to get that lower rate. I would suggest, if you refinance and it drops your mortgage payment down, if it drops it down $270, man, just keep paying your mortgage with that extra $270, because you're going to pay off your mortgage extremely fast. I didn't even calculate that out, right? If you paid that $270, you're paying off your mortgage in 22 years. That is so much faster than 30 years. You're going to save yourself 8 years worth of mortgage payments just by keeping your mortgage payment the same and just paying that and having that lower rate, right? So hit me up if you guys have any questions. If you have any questions on the Excel stuff, I'm happy to answer anything for you, and we'll catch you guys next time.